There's a quiet financial shift happening across the US. No breaking news, no emergency press conferences, yet it's showing up every paycheck for millions of households. Over the past few decades, many Americans have gradually increased how much they work. And yet, they're saving less, carrying more debt, and feeling financially more fragile than past generations. Household debt now sits in the multi-trillion-dollar range. Credit card interest rates are climbing. And something subtle but serious is happening. Effort alone is becoming a weaker predictor of financial progress. This shift is hidden in balance sheets, interest rate math, and long-term policy decisions. But it affects your money, your savings, your mortgage, your retirement. So the question isn't why people feel stretched, it's why this pressure is building now. And more importantly, what does this mean for your money next? Today, we'll break this down simply, clearly, and without panic. Because this is global economics, but the risk shows up at home. For much of the 20th century, the American middle class was built on a predictable path: work consistently, earn steadily, buy a home, retire with stability. From the post-war years through the late 1970s, this largely worked. A single income could support a household. Wage growth broadly tracked productivity. Major costs like healthcare and education rose slowly. Debt was present, but manageable. Savings earned interest. The middle class wasn't wealthy, but it was financially resilient. So what changed? We have to look beyond headlines about inflation or interest rates. The truth lies in financial systems that quietly reshaped money flows. This isn't about personal failure. It's about structural shifts that took decades to accumulate. In the late 1970s and early 1980s, American productivity kept rising. Workers produced more value per hour than ever before, but wage growth slowed. From the post-war period through the mid-1970s, productivity and wages moved together. After that, the connection weakened. Globalization expanded. Manufacturing moved overseas. Automation reduced demand for some labor. Financial markets gained influence over corporate decisions. Corporate profits rose. Stock markets performed strongly. Executive pay accelerated. Meanwhile, median wages stagnated. To maintain living standards, households adapted, not by earning more per hour, but by reallocating time. Dual incomes became common. Overtime normalized. Side jobs replaced long-term savings. The middle class didn't collapse, it absorbed pressure. And absorbed pressure often looks manageable, until it accumulates. As income growth lagged, debt expanded to fill the gap. Credit access widened. Student loans increased. Mortgages became easier to obtain. Debt was framed as opportunity. For a while, it worked. Debt allowed households to buy homes, finance education, smooth spending during lean months, but debt is a multiplier, not a substitute for income. When wages stagnate, debt doesn't adjust. Interest compounds silently. By the early 2000s, many middle-class households weren't just working more. They were increasingly dependent on borrowing to maintain stability. The 2008 financial crisis wasn't just a collapse. It was a stress test of household finances. Home equity evaporated. Job losses exposed thin savings. Retirement timelines extended abruptly. The recovery appeared strong. Equities rebounded. Corporate balance sheets recovered. But for wage-dependent households, recovery lagged. 2008 became a wealth distribution event. Assets recovered faster than incomes. Ownership mattered more than effort. This wasn't immediately obvious, but its effects compounded over time. Today, many households are working longer hours, delaying retirement, managing higher fixed expenses, carrying more debt, yet financial confidence remains fragile. The reason isn't luxury spending. It's rising costs of essentials. Housing, healthcare, education, insurance, energy, even modest pay increases can be overwhelmed. A raise doesn't create security. If housing rises faster, insurance accelerates. Interest costs climb. The pressure isn't dramatic, it's cumulative. Governments lowered rates. Liquidity injections supported markets. Temporary income support helped households. These measures prevented collapse, but they didn't rebalance the system. Low rates boosted asset prices more than wages. Short-term relief didn't resolve long-term cost structures. Income growth lagged asset appreciation. Ownership benefited disproportionately. Many middle-class households hold limited appreciating assets relative to obligations. Interest rates. Debt payments rise as rates increase. Housing. Prices behave like leveraged assets, not just shelter. Savings. Cash often loses purchasing power over time. Markets. Rewards patience, punishes volatility. Middle-class households face a dilemma. Growth requires exposure, stability requires protection. Lesson 1. Earnings matter, but structure matters more. Security depends on how income is positioned, not just how much is earned. Lesson 2. Debt strategy is risk management. High-interest debt is predictable, income often isn't. Lesson 3. Financial awareness is a defensive skill. Understanding inflation, rates, and assets improves decisions even without active trading. Reflection. If financial conditions have changed, have your assumptions changed too? The middle class isn't under pressure because effort disappeared. It's under pressure because the financial landscape evolved, while expectations stayed anchored in an earlier era. Effort still matters, context matters more. Stability now requires awareness, and awareness creates optionality. The biggest risk today isn't volatility. It's operating with outdated assumptions. If you want to understand these shifts before they show up in your balance sheet, subscribe. Like the video if it helped clarify the bigger picture. And comment below thoughtfully. Do you think the middle class squeeze is driven more by income, costs, or asset ownership, and why? Smart financial decisions aren't reactive, they are informed early.